My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends, just trying to make a little money. My job is not just to entertain, but to put it all in context. So call me 1-800-743-CNBC. Tweet me, Jim Cramer. It's hard to believe, but this market's now been up for 6 straight weeks. That's right, despite interest rates running higher since mid-September, despite being on the verge of an election where both candidates want to pile on trillions of dollars of debt to an already unfathomable amount of borrowing.
The House of Pain.
This market seems like it can't help itself from going higher. So on a sedate day where the Dow advanced 37 points, S&P gained 0.40%, NASDAQ climbed 0.63%, we have to recognize what's causing this era of bullish feelings, namely the Federal Reserve. Because ever since it's cut rates on September 18th, this market's done almost nothing but go up. Of course, it's not just the Fed. This earnings season, we've been blessed by some amazing quarters already. Just today, we had Netflix, amazing blowout, Intuitive Surgical last night. Both, they roared. That's on top of some stellar numbers from the banks to kick off earnings season.
All aboard!
So, can the rally continue for a 7th straight week? I think we have to go to our game plan to find out. Next Monday, we get results from SAP. This is the German software giant and Nucor, America's largest steel company. SAP has been delivering stellar results as it advises companies on tech strategies, including cloud enterprise resource planning and adopting artificial intelligence. They're very good. They have a lot of ideas for you, but a lot of companies love to sign up with them. Nucor stuff, though. See, while steel pricing is weak, the old hedge fund playbook says you should buy steel makers like Nucor after the first rate cut because that's when their stocks typically start to turn ahead of pricing of steel. Could be an interesting level to get long here. Tuesday is one of the trickier days to navigate. In the morning, we have General Motors, one of the cheapest stocks in the entire S&P 500. The traders believe GM's future earnings will collapse or it would not have such a low-priced earnings multiple, PE multiple. I think it's a bargain, even as it may be hurt by tariffs on Mexican-made cars if Donald Trump wins in November. Tuesday's also a real big aerospace morning with numbers from RTX and GE Aerospace. Now, both stocks have been flying high. I bet that continues after the report, and most likely they will raise estimates. These are two fantastic, well-run companies. Now, one of my Travel Trust favorite companies is Danaher. It's an amazing life sciences conglomerate that I think might be ready to return to its old greatness. The stock's been doing nothing for ages. But then again, Danaher can't outrun its clients, and its clients are new young biotechs with deep pockets. Unfortunately, that's a scarce commodity in this environment. Still, there are enough young biotechs, and of course just older healthcare companies that are out there that I bet Danaher can tell a story of an expanding client base and growing orders. It's a very important position. We covered it this week when we did our monthly meeting. I'm obviously on tenterhooks about it. I am concerned because it has not done well. Next up, there was some back and forth on Procter & Gamble, but all in all, people are okay with today's earnings report. Well, they like Kimberly-Clark more. These two mortal enemies butt heads constantly all over the globe, but Kimberly-Clark's been in reorg mode, and it's working. Now, we have so many winners reporting, but there's one laggard that I figure could break out here, Norfolk Southern. It's got a new CEO, Mark George, who I think will bring some financial discipline to this great railroad. Norfolk Southern could put up some excellent numbers. Previous CEO should get some credit for that, by the way. After the close, we hear from Texas Instruments. We've been hearing a lot about how semiconductor companies are in the doldrums, the ones without AI, that is. Texas Instruments falls into that category. But this company's become much more focused. I like it ahead of the quarter, even though it has a little more cyclicality than most chip makers. I like it because interest rates are coming down. Here's a shocker. No matter how poorly Boeing is run, and it's become the benchmark for bad management, the big institutions are possibly Pavlovian about buying the stock. They can't get enough of it. Boeing has to hope that the buyers can maintain their appetite through an already miserable pre-announced quarter because it needs to sell about $25 billion in stock to fix its balance sheet. And I'm betting that deal could come very, very quickly. Maybe even the day the company reports. If you really want to own Boeing, save your powder until after the secondary offering, as it will most likely come at a nice discount. The flip side of Boeing, sometimes companies can practically print money simply because they're so well run. Take Coca-Cola. Under the steady hand of James Quincy, Coca-Cola has become a low-risk juggernaut with a solid dividend. Definitely a stock that is worth owning. Data centers remain one of the hottest themes in the market. And if you're looking for a pure play, go with Vertiv, which makes electrical equipment for these warehouses full of servers. Now, that said, this stock is so red hot that it might not be able to rally on earnings unless it raises its forecast to unfathomable levels. Then again, Virtu's business is so strong, it's so strong that unfathomable might be fathomable. After the close Wednesday, it's Mega MAGA Man Musk and the Tesla show. People didn't like his recent self-driving presentation, so I think he's going to try hard and deliver a really good set of Tesla numbers because they have been lowered and lowered and lowered, so you can beat them. That's when Elon Musk does his best work. IBM also reports after the close, and I bet we'll get another beat-and-raise quarter. Why? Because it's become a beat-and-raise machine under CEO Arvind Krishna. Enough said. Earlier this week, a semiconductor capital equipment company called ASML rocked everybody's world by giving out a ridiculously poor forecast. Is every company in the industry of capital semiconductor equipment similarly damned? We're going to find out when Lam Research reports. Now, Lam Research is a much better company than ASML. I think it'll tell a good story. I think it's got a healthy buyback. Very risky, though. If it's just only because expectations have been lowered here, it might work. But the problem with Lam is that what happens if ASML is at all right, then Lam won't pop. But that's not that big a risk. One serial beaten raiser is T-Mobile, and they reported to the close. Can it keep up the winning streak? T-Mobile's had such an amazing run that I'd be a tad circumspect here. Maybe by half and by before the quarter reports and then half after. Thursday's jam-packed. For starters, I'm going to be with Chevron in the Gulf of Mexico. Can't wait. But what about earnings? Southwest Air is looking at a long and hard proxy fight because it hasn't been willing to give in to the demands of Elliott Management, a very, very smart hedge fund. I think Southwest would have an easier time fending off the activists to report a good quarter like what we just got from United. Honeywell recently announced a major reorganization, but can it match that with some good earnings numbers? You know, that last quarter was just okay. In the interim, we got the reorg, and the stock is soared. We own this one for the Charitable Trust, and we're telling members of the club to stand pat. Could this be the quarter that gets UPS out of its funk? It's possible. And that almost 5% yield might cushion the blow if something goes wrong. There was a time when people seemed to ignore the success of David Gitlin at Carrier. Not anymore. You can't. The stock's getting its due. It's now had such a big run that this climate control player may not pop on the earnings numbers, but I sure think they're going to be strong. We keep wondering how Hoka's doing and whether it's still taking share from Nike. Hoka is a division of Deckers Outdoor, which reports after the close on Thursday. I anticipate a strong number for their insurgent running shoe division. More Clockwork love. Texas Roadhouse. Everybody seems to love this favorite restaurant chain. It's got an $11 dinner everybody's raving about. Put it up there with Brinker and Wingstop as winner chicken dinner. Finally on Friday, we got Colgate-Palmolive. And here's one where I stand. It doesn't matter where I stand. Now, I say this, the street, it's kind of an unnatural thing, frankly. The street loves Colgate-Palmolive. I think that the love is way overdone, but that does not matter. Colgate always wins. Kind of drives me crazy. I just want to find out what people really think that they love it so much, but it doesn't matter. It's inscrutable. Bottom line, can we have a seventh up week? I say why not? Let's take questions. Let's go to Bruce in Texas. Bruce.
Jim, I can't believe I'm on the phone with you.
I can't believe I'm on the phone with Bruce. How about that? Bruce is on the phone. Okay. Let's go, Bruce.
I watch you every night and enjoy your show. I've built my Mad Money account into quite a interesting and vital piece of my total portfolio.
I love that. By the way, can I just tell you, Bruce, I'm going to Texas to see the Eagles play the Cowboys, but I'm going to Houston and Dallas because I love Texas. I take a couple trips down there a year, and it's one of my favorite places to go.
Yeah. I live out here in the swamp east of Houston, and we love it.
Oh, yeah, you're in Nacogdoches? I've been in Nacogdoches. I've been to a lot of the towns there.
I'm in Liberty.
I know Liberty. I've been to Texas like 100 times. I love Texas. So go ahead.
Anyway, hey, I'm not calling about a specific stock. I'm just, I want to, your interview with U.S. Steel Chairman David Burr got me thinking. And I'd like your opinion on why Donald Trump and Biden-Harris are both against the merger of Nippon with U.S. Steel.
Well, I tell you the reason why. Because there's an election. Because there's no doubt about it. I am telling you right now. If Nippon Steel buys them, there'll be more jobs created than if not. But that said, I also believe that Cliffs could do a great job. Cleveland Cliffs. I just think that this is political time. No one ever. Look, Pennsylvania is the most important state in the union when it comes to the election. So you got to go with, if you're running for president, you got to just presume, hey, I got to block this thing. But that said, the people from Pittsburgh, I bet they would vote for it if they had a chance. Let's go to Adam in Georgia. Adam.
What's going on, Jim? How you doing, bud?
Good. I'm worried about the Eagles playing the Giants. You got to, lately, I'm just afraid of being booed by the coach, to be honest.
Okay, well, it's all good, man. Hey, okay,
maybe.
check it out.
Maybe.
How do you think Home Depot's doing, Jim?
I think Home Depot is doing unbelievably well. Now, unfortunately, I think sometimes it's doing too well because those storms were so horrible. But Home Depot's always there helping on that. It sells at 27 times earnings. I don't think it really sells at that. I think it sells at a lower price earnings multiple. Why? Because I think the earnings are going to be sharply better than expected. And I'd like Ted Decker to come back on the show because he's a true gent. Let's go. He's a CEO. Let's go to Glenn in Georgia. Glenn.
Booyah, Jim. This is Glenn from Warner Robins, Georgia. Long-time watcher, first-time caller. Thanks for taking my call. You are one of my heroes.
Oh, thank you. I sure try. My team knows it's like, wow, it's Friday. This is only I think this is like our 17,000th show. All right, go ahead.
Hey, Jim, my question is on Intuitive Machines, ticker symbol LUNR. Stock has run up to $11 this year, earlier in the year, on its first lunar module launch, but it quickly pulled back to $5, and recently NASA's given them a $4.82 billion contract for 3 more lunar modules. Should be announcing the date for its next one soon. What do you think about the stock? I own a large
Okay, I'm of two minds of this. First, it's incredibly speculative, but second, if it involves space, it's a good spec because people just love it. It's like uranium and space are the two specs. LUNR, by the way, that's a NASDAQ company. Right? Can we have a 7th straight up week? I say, why not? As long as the strong earnings will continue, we will. I think the good times can keep rolling. Mad money tonight. We were off the charts a couple weeks ago on a large short position, 10-year Treasury note futures, and we can't stop thinking about why investors are shorting Treasuries. I'm thinking the situation. I think I've got the answer. That Netflix's quarter was anything but chill, with the stock soaring in today's session. I am sharing all the major line items you have to know from that report, and that was a fantastic conference call. Plus, we held our Investing Club monthly meeting this week, exclusive for CNBC's Investing Club members, of course. And we had so many amazing questions that we decided to answer more of them tonight. It will be like a snapshot of what you get if you belong to the club. I'm telling you, I'd match the club against Netflix any day of the week. You don't miss it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
2 weeks ago, Carly Garner, one of our go-to technicians, flagged something huge in the bond market. Large speculators, meaning money managers, have built up a gigantic net short position in the 10-year Treasury futures, the biggest she's ever seen. Even though the Fed's cutting rates, these money managers are betting that Treasury prices will come down and the yields will soar. In other words, they're gambling that long rates are headed higher, not lower. And the craziest thing is that in the past month, they've been dead right. The yield on the benchmark 10-year Treasury note peaked at 5% roughly a year ago, before falling sharply to 3.8% late last year. After spiking early this year, it became clear that the Fed would eventually start cutting rates this fall, and then the 10-year yield came down. Okay, perfectly normal, right? On September 17th, the day before we got the tremendous double rate cut, the 10-year had a 3.6% yield. But since then, it's been just over a month, and now the 10-year is yielding 4.08% because bond prices have come down dramatically. That's why I say that people shorting Treasuries. They've been really right. Now, during that off-the-chart segment 2 weeks ago where I talked about Carly Garner's work highlighting the huge net short position in the 10-year futures, we didn't spend much time focusing on why that's happened. I had some guesses, but I couldn't really figure out what was motivating these bond guys to fight the Fed, which is what this trade amounts to. This week, though, a real heavy hitter came out and explained his rationale behind the trade. On Wednesday, Stan Druckenmiller, a legendary hedge fund manager who's now the chair and CEO of the Duquesne Family Office, sat down for a long Bloomberg interview and argued that the Federal Reserve is being too soft, too dovish. He thinks they're trying to stimulate the economy too soon and too aggressively, and he's betting that will set off another wave of inflation. And that's why Druckenmiller says he's shorting treasuries. Makes a lot of sense. He figures that if the Fed's wrong and inflation roars, treasury yields will surge. On the other hand, if the Fed's right, he doesn't see treasury yields coming down that much, because even if the Fed cuts by 100 basis points from here, the Federal Reserve rate would stand at a range of 3.75 to 4%. Remember, short rates usually stay below long rates unless we're in a recession. And with the 10-year currently above 4%, that's perfectly consistent with 100 or 150 basis points of rate cuts. In other words, treasuries have been plunging in price and rising in yield because they were trading as though the Fed would slash short rates to incredibly low levels. Anything that obstructs that process will push up the long rates set by the bond market. For example, the biggest single-day jump in long rates came on October 4th when we got a red-hot September non-farm payrolls report with much stronger than expected job creation and average hourly earnings up 4%. In response, the yield on the 10-year jumped from around 3.85 to nearly 4% in a single day. It was really ugly. That's a big move. Ugly meaning rates went up. Every time we get some strong economic data, naturally long rates go up. To be fair, that's exactly what is supposed to happen, though. Just last week, when the September CPI reading came in a touch hot, long rates spiked. Just yesterday, when September retail sales came in a bit too strong, long rates spiked again. Every time we get a bullish read on the economy, investors can say, quote, and I'm going to kind of rhetorically, the economy's not just holding up okay, it's running hot. Why the heck did the Fed do a double cut in September? Should it even have cut at all? Is this thing getting way out of control? Does Jay Powell have it in control? Will they have to reverse course after just one rate cut? Heck, maybe they'll have to start raising rates again. There's all the kind of stuff. That's what's going on. That mindset is why there's a huge short position in treasuries right now. But I think these guys actually are getting ahead of themselves. As I see it, Jay Powell still has things very much under control. And let's cut the pretense. That's what this trade's all about. People are shorting treasuries because they believe that the bond market will defy the Fed's rate cuts and long-term rates will go up. They're betting that the Fed will lose control of the situation. Druckenmiller basically said so much on Wednesday. I disagree. Since his appointment in early 2018, Jay Powell's had to navigate the introduction of widespread tariffs in 2018 and 2019, the unprecedented COVID-19 pandemic, and then the worst bout of inflation in 40 years. He handled all these challenges with a great aplomb. At the very least, I think that he and his team, the Fed, deserve the benefit of the doubt. And frankly, I have very little doubt that Powell can navigate this period of crosswinds. Of course, if the economy keeps throwing off strong numbers, we definitely won't be getting more double rate cuts anytime soon. I don't expect that. They might even skip some meetings and go month to month between rate cuts. That's what I think is going to happen. But I do think that rates are ultimately headed lower, and the people's shorting these treasuries, I think they're going to be wrong. Of course, there's one big caveat here, and that's the election. Both candidates have pushed potentially inflationary policies, as I said at the top. If Trump can win enough of a majority to pass his huge tariffs, or Harris expands housing tax credits and de facto subsidy that could push home prices higher, then inflation might stage a comeback. But I'm not betting on that. I think both parties are terrified of being blamed for inflation, which almost single-handedly sunk Joe Biden's presidency. No matter what the candidates campaign on, I don't see their allies in Congress taking any chances with inflation beyond the usual unwillingness to balance the budget. Plus, at the end of the day, the people betting against treasuries have gotten way ahead of themselves, I think. They've gone out on a limb to fight the Fed, and that rarely works out well for anyone involved. Also, when you see so many people on the same side of the trade, as is the case here, that side often tends to be wrong. I bring all this up because even if I'm wrong, let's say I got this thing wrong. This huge short bet position in treasuries will have big implications for the stock market. If the bears shorting treasuries are right, we'll have much higher interest rates. That would be bad for the economy, bad for the stock market. If the bears are wrong, long rates will gradually go lower over time. This will crush the legion of short sellers who will have to cover their short position by rapidly buying treasuries. Now, get this. This could cause some havoc in the stock market. It could take a hit because they may end up selling stocks to raise enough money to close out their short position in the bond market. By the way, I know that sounds attenuated, but that's what Carly Garner warned us about in the first place. The bottom line, I still believe that this shorting the treasuries bet is a mistake, and the Fed will continue to win. There's a reason you don't fight the Fed. Sure, the bond bears have been very right for the past month, but once Wall Street adjusts to a stronger economy, I think it will be much harder for them to keep being right, and that's what matters. Mad Money's back after the break.
Coming up, Netflix and Thrill, the streaming giant soaring after earnings. Cramer talks Bulls, Bears, and binge watching next.
Early last week, While looking at every piece of research imaginable in preparation for earnings season, a pair of earnings previews for Netflix hit my eye. On the one hand, Barclays downgraded Netflix to underweight, meaning sell, while a separate team at Piper Sandler gave the stock an upgrade, taking it to overweight, meaning buy. At the time, I highlighted the analyst face-off, and by the way, I stuck my neck out and I said, the bulls will be right. And you know what? Oh, I'm basking. It feels great to say I told you so. When Netflix reported last night, it shot the lights out, which is why the stock caught fire today, up $76 or 11% to a new all-time high. Congratulations to the team at Netflix. You are really good. This was truly a fantastic quarter. The company posted a solid revenue beat, 15% growth. The bears were worried about profitability. Well, guess what? Netflix operating margins came in 29.6, in line with expectations, up from 22.4 in the same period last year. All told, they earned $5.40 per share, 28 cents ahead of the estimates. That's 45% earnings growth. That is a resounding victory for the bulls. Now, to be fair to the bearish analyst at Barclays, he wasn't really necessarily saying this quarter would be a disaster. His negative outlook was longer term than that. But the results we got last night certainly take some of the wind out of the bears' thesis, and you sure wish you hadn't shorted it, or you wish you had bought it. Maybe that talks you out of buying it. Barclays was worried about what they call, quote, unrealistic long-term margin expectations, quote, which is hard to take seriously until Netflix starts missing the margin estimates for those, certainly. Longer term, the bears fear that Netflix will have to lean on new growth levers to maintain its double-digit revenue growth rate, and that some of the levers they've already pulled, like paid account sharing, are pulling that growth forward. Again, it's only one quarter. But Netflix had net subscriber additions of 5.1 million. Boy, is that ever organic. Much better than the 4.5 million that Wall Street was looking for. They also, by the way, when you listen to the call, there's so much expansion that could happen. Of course, look, the bull versus bear argument came down to the stock's supposedly premium valuation. But the valuation is based on future earnings. So let's talk about the company's guidance. Management forecast for the current quarter was terrific. Better than expected revenue, better than expected operating margin, better than expected earnings. And the party didn't end in the fourth quarter. We went to guidance overtime, with management also giving us the preliminary outlook for 2025. For next year, Netflix is forecasting 11 to 13% revenue growth, operating margin around 28%, both in line with expectations. Remember, those concerns about whether these guys could maintain double-digit revenue growth? Well, Netflix clearly thinks that won't be an issue in 2025. Never a great sign when your negative thesis gets batted down by management's outlook for the next year before you even have time to buy this year's Halloween candy. We bought a lot of dots yesterday for like the dot plot joke, and that's what I'm going to give away. Not the individual. I mean, just give away the whole boxes. Come to my house. That said, there's more to Netflix's premium valuation than just the numbers. If you listen to last night's conference call, which is such a hoot, co-CEO Ted Sarandos, my love, did a great job of breaking down just how expansive their library of content's become. He talked about the benefit Netflix saw for the return of fan favorites like season 4 of Emily in Paris, season 8 of Selling Sunset, season whatever of Cobra Kai. Some of you are probably sitting around saying, wait a second, I've never heard of these. Or how did a Karate Kid spinoff get a 6th season? But that's just how huge their library is. Netflix can keep pumping out multiple seasons of popular shows that you've never heard of, maybe because their algorithm knows it's not your style. They got something for everybody. That's the point. As Netflix explained on the call, this content library is sucking people into the point where they're now averaging 2 hours of viewing per member per day. You probably ask, how could someone watch 2 hours of Netflix per day? I said that to myself last night while watching 3 hours of the worst football I've ever seen in my life. Now, there's a huge part of their advantage. To quote Ted Sarandos, quote, we're seeing a lot of our competitors use bundles to find growth in their businesses, end quote. And they have to offer these bundles, as Sarandos puts it, quote, given the narrow scope of the libraries on these services and the fairly limited engagement. Ooh, that was so brutal. Ooh, so accurate. The legacy media streaming services just can't compete with their wide assortment of police procedures, fireman shows, hospital dramas, and just all-around shoot-'em-ups, because that is so not what Netflix is about, huh? Isn't it funny? They were doing the same thing as we did when I was in college. There's something wrong there. And this gap seems like it's getting wider, frankly. While legacy companies try to bundle their narrow streaming libraries, Netflix is adding more and more value, going all over the world, getting great stuff. These shows just keep coming. Outer Banks season 4 out now, season 2 of Squid Game coming up, and don't forget the Christmas Day NFL games. And listen to this; these are really good. They got a doubleheader: Chiefs versus Steelers. Okay, Steelers got a good D, but then how about this? Ravens versus Texans. Just That could really wreck Christmas. Just a really great lineup for Netflix's first foray into live football. I could use a Perfect Couple season 2 or 3 or 4. Oh, come on. Perfect Couple into an eternity. After listening to management's rattle off their current and future content slates, I started wondering, how the heck can people only watch 2 hours per day? They have, and considering Netflix disclosed that their share of TV viewership is still less than 10% in their biggest countries, I could see that number going up. Honestly, just keeping up with all this programming is practically a part-time job. So glad that they tell you what people are watching all over the globe before I get started. All this content just makes it more likely that Netflix's move into ad-supported subscription plans will make a difference. There's been a lot of focus on the ad tier, and with the company putting an end to subscriber disclosures next year's management shifting attention to what it calls its most important metric, engagement, well, it makes sense. More eyeballs equals more ad money. It's the right thing to do. These guys do very little that's wrong. Management says they're already seeing momentum in the ad tier with membership on ad plans up 35% quarter over quarter. These plans account for over 50% of new signups in the countries where they're available. It's the right thing at a time when people don't want to spend more than $5 for a McDonald's burger. But even ignoring these numbers, management had very bullish commentary about expanding their programmatic advertising capabilities with a company called Trade Desk, whose stock we just love for ages. You know I've been a big fan of the company, and I'm confident they'll be able to get this new ads business scaled sooner rather than later. The rationale just makes too much sense. Old people watching Seinfeld, I'll give them a farm ad. Younger people watching Outer Banks, serve them an Elf Beauty ad. I don't know. Ted Sarandos also gave us some insight on AI, which he says isn't a threat to Netflix, as anything that increases the quality of entertainment will ultimately benefit his business. But AI should also help with placing ads, while making Netflix's recommendation for what to view next even more accurate than before. So terrific. Now, I'm not saying Netflix has become an AI play, not at all. I'm just saying that between the expanding library, clear customer interest, and the ad tier model, and their ability to harness the power of artificial intelligence, we have a lot of positives here, and it's going to translate into a lot of money. Bottom line, if you were worried about Netflix not having enough levers to pull in orders to generate growth going forward, or at least enough growth to justify the stock's price earnings multiple, I think those concerns have been put to bed by last night's earnings report. Near term, the Netflix bears will hibernate, but just remember all these positives when they inevitably come out of their den and try to maul this best-of-breed company with a stock that I think can rock on higher for a long time. Let's go to Fernando in Texas. Fernando.
How's it going? Good to hear your voice. First time caller.
Thank you, man. I'm glad you called, Fernando. What's going on?
Just looking to see what your thoughts are on Dave & Buster's, PLAY.
Too episodic. You'd be good, then bad, then good, then bad. Best of breed does not do good, then bad, then good, then bad. And I like to buy best of breed. Let's go to Ron in California. Ron.
Hey, Jim, thanks for taking my call. I'm a big fan. I've always enjoyed being educated and entertained at the same time when I watch.
That's what I want. Thank you very much.
Okay. So on September 20th, my wife and I went to the Sphere in Vegas to see the Eagles concert. It was the most amazing live event I've ever attended. The sound and all the videos surrounding us were absolutely incredible. Entering the venue, they were selling lots of merchandise, food and drinks. In fact, an 8-ounce bottle of water with the name Sphere on it was selling for $8. So I figured any company selling water for $1 an ounce had to be a good business. When I came home, I immediately bought shares of the Sphere stock, SPHR. A few days later, the stock got an upgrade to buy from one analyst, on just this last Wednesday, it announced that it's going to have a second venue opening in Abu Dhabi. However, the stock doesn't make a profit, number one.
All right.
On October 8th, the executive vice president and the CFO, for unknown reasons, decided to step down. And then I discovered that it has a short ratio of more than 8 and a short percentage of outstanding shares of 9.
But, look, we recommend the stock lower. We're sticking by it. It's kind of a great spec situation. Yeah, that's the way I would put it, great spec. When you said the Eagles, the first thing I thought of was like, wow, the Eagles. Did the coach boo the crowd? And then I realized, no, you were talking about the music Eagles, not the team that I spent a fortune going to games for and get booed anyway because I didn't like the product. Who knew? Go to Sphere. They don't boo. Netflix's results last night should do enough to quiet the Bears' fears about its growth prospects. Just remember, all the positives here the next time this best-of-breed company does get hit, because it will, because there's always some analyst trying to make his name blast in Netflix, or her name. Much more Mad Money ahead. Investing Club members send in some amazing market questions for the monthly meeting. We didn't get them all. I got to show you what the club is really like. If you don't really belong, then I just presume you don't really like stocks. But why are you watching? Okay? Boo. Oh, I'm sorry. No, I'm not a coach. Then, sometimes in business, you need to recognize your vulnerability and become something else, or else face the fate of disruption. I'm sharing a couple of ideas to help you invest in the thesis. And, of course, all your calls rapid fire in tonight's edition of The Lightning Round. So stay with Cramer. Earlier this week, we held our Investing Club monthly meeting, which I love. Once a month, Jeff Marks and I get together to walk club members through our thought processes of how we make decisions for the portfolio. We discuss 2 new stocks. Of course, we also go over all the current holdings, break down our new positions, and then we take questions from you, or at least you who are members. My favorite part of the meeting is taking the questions. Since I didn't have enough time to go over all the questions, well, you know what? I'm going to give you an inside look at what we do for the club tonight. I'm going to answer some questions right here, right now. Why don't we start with Todd, who's from the U.S., so thank you. I have held Carrier for a long time, and it's run up into the 80s recently. Should I trim or hold on? I still like the long-term prospects. Okay, so here's the way I look at it. As I said at the top of the show, I think Carrier's excellent, but the stock has run a great deal. It is not a breakout stock. I don't expect it to pop 2 or 3 points, but I love it as a long-term hold. And if it does come down, I will have to push it as a long-term buy. Next, Bob in Florida says, Jim, what is your current thinking on cybersecurity? Should be a good area long-term, but with so many companies in this sector, picking a winner can be daunting. No, it's not, because we have 2 of them. That's why we're not. I know people say we're not diversified, but it's one we have very small position. Actually, both are small. Okay, we have Palo Alto Networks, which I just think is. Let me just say that there was a very positive note today out about Palo Alto Networks, and it was really, really set. It took it to like 430 price targets. So that's pretty good. The other is CrowdStrike, and that's George Kurtz. And why did we do both? Okay, the reason we did both is this is probably the fastest growing area other than AI, and I wanted another tech position, and I didn't know what to do. And sometimes it just happens that you say, you know what? Breaking the rules, buying 2 great ones, Nikesh Arora and George Kurtz. That's right, Palo Alto and CrowdStrike. Now, let's take a question from Mary, also in the U.S. Well, great. She asked if and Mars. I don't know. If you were looking to start a position in a restaurant stock for your portfolio, would you choose McDonald's, Chipotle, or a newer company like Cava or Sweet Green? How about all 4? Let me throw in another one, which is Texas Roadhouse, and I might even be interested in Wingstop. My problem is there's so many stocks in that sector that are good. I have literally been monitoring them incredibly closely, waiting for one to break down, and I didn't pull the trigger at McDonald's on that $5, even though I talked with management about it. That was my bad. Wingstop, we've had them a bunch of times. Haven't pulled the trigger. My bad. Chipotle, can you believe it? Now I want to know more about the, it's not, Scott's was here, but want to know more about the successor. They're just all good. Sometimes you can't buy them all. Next up, David in the U.S. wants to know, under what conditions is PEG rate a useful measure and when it's not? It used to be much more measured. This is a way to be able to measure the growth rate and see whether it's a company's too expensive. But when you have like Coke and Pepsi that are so high and that their growth rate is beyond what you would ever think, and those are 2 very natural companies, I just picked those as big because you all know them, it says to me it's not as good as it used to be. I'm literally evaluating that. I did it earlier this week for a couple of stocks that are under 2, and I kept saying to myself, when is this going to be more valuable to me? So let's put that a work in progress. That wouldn't have been the case a couple years ago, but I just said, yeah, PEG rate, got to know it. Now, turning to tech. A man in the U.S. asks, I currently own no Meta, but I'm interested in adding some to my portfolio. What would be a good entry point without chasing the stock? There hasn't been an entry point where you're not chasing the stock for 200 straight points. It's not a good way to look at it. What you do want to do, though, is you want to say, okay, listen, if it comes in ahead of the quarter because people are worried, maybe I buy a little, but I've got to tell you, this company is not expensive, and the reason why it keeps going up is the estimates keep going up. It's not price earnings multiple expansion, so to speak. Meta's a really good company, and Mark Zuckerberg's a really good CEO. Now, let's take a question. I mean, that's a better way to leave it than pick a price. Now, let's take a question from Paul, who's in the U.S. With all the storms hitting the East Coast, is now the time, he's from the U.S., he's probably aware about that. Now the time to buy insurance company stocks? Don't they raise the rates after all the storms? Yes, they do, and that's why you're going to buy Chubb. Under 300, Chubb's amazing. I think it's fantastic. There was a guest on today who was talking about Chubb. He should have been more effusive about the CEO, Evan Greenberg, who's unbelievable. And last but not least, Pat, from Florida, which is in the U.S., says, what are your thoughts on Lululemon, which is what my great friend Aaron Burnett used to call it when I worked with her, Lululemon. Seems like a good time to start buying. I have to tell you, China is doing incredibly well for Lululemon. The valuation has come down a great deal. I do worry that that it's too expensive, but it is high quality. I'll bless an options position in Lulu. I rarely do that. I'll bless an options position because I think you're going to be right. I find, again, we have to understand. I think about this stuff. The reason I like the question, this is what I think about every day. I mean, I got Matt Boston. I go back and forth on Lulu. I'm starting to think, well, when is it time to be able to think about RH, restoration hardware? This is what you do. We kick around ideas the way that some people kick around, I don't know, how about players for football teams for fantasy? It is a remarkable thing to be able to converse in stocks, and I thank everyone in the club for allowing me to do it with you. Man, money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It's time for the lightning round. Back to our graphical numbers, saving the stocks. The course, my Stanford is going to play this down. And then the lightning round is over. Are you ready, Ski? That is time for the lightning round. Let's start with Irv in Louisiana. Irv.
Booyah.
Booyah.
Oh, yeah. Jim, my question is about energy transfer. Now, I bought this stock about 10 years ago after they cut the dividend in half.
Yeah.
I got it at just over $8 a share. And over the last 10 years, I've got pretty close to over 600 shares. And it's doubled in price. And I'm quite satisfied with the dividend. But my question is, why is the stock price in such a doldrum?
Well, it's actually come up over time. It trades with the whole group, and the group is actually trading very, very well. I just say, you know what? We got the yield, because people were worried when they cut the dividend, people just never forgave them. I was one of them, but I have forgiven them. You're in good shape with ET. Let's go to Jack in Colorado. Jack.
Jim, it's fantastic. I don't know what to say. Booyah, I get to say that. All right.
That's fine, man. Booyah right back at you. How can I help?
I got to hear about Walgreens. Been in it for a long time. I dwindled my holdings down, and I'm looking at it. I've read your book, Mad Money book, and I went, Jim said, don't jump into something just because it's cheap.
Yeah, that's the problem. Now, the good news, Jack, is that Tim Wentworth is really an excellent CEO. The bad news is you're up against Amazon. And so even a great CEO, it may be proving too much. But I'm a believer in Tim. I really hope it works. But that is one tough spot he's got himself in. Let's go to Truman in California. Truman.
Hey, Jimmy boy. I want to I'm coming to you with a little gas. I want to get a lot more gas again. And then, so I'm having trouble figuring out what levels of that gas price and oil is reasonable for firms on Coterra is what I started with.
Okay, let me just say about Coterra. We own it. It's the only one that we own in the oil and gas patch for the Travel Trust. It's the one I feel the most confidence in. Why? Because it's half oil, half nat gas, and it's a low-cost producer oil, and it's the lowest-cost producer in the world, nat gas. It can make money even at these levels. Tom Jordan is money. I think you buy the stock. I can't believe that it's still independent. Let's go to Sharon in Minnesota. Sharon.
Hey, Jim. This is Sharon. So I am a club member, and I really appreciate everything that you do and everybody on your team. Anyway, you had said that I had bought ELF, and I'm down a lot. But that's okay. I was waiting for the bounce, like you said. And a few days ago, it looked like it was bouncing a little bit, but it then went down again.
Well, remember, this is a very tough situation because all of cosmetics are in a downturn that is so staggering that it caught everybody by surprise, especially Fabrizio Freda at Estee Lauder. I think Estee Lauder is not as good as ELF, but I recognize that this group is in the doldrums. I don't want to make a single call on a group decline. I do think that when they come back, this one will come back faster than all of them. Let's go to Bill in Massachusetts. Bill. Bill, go ahead. You're on. It's with Jim.
Jim, this is...
Break it up there, Bill. Can you try it again?
Hello? Jim?
Yeah, Bill, it's Jim. You got me. Go ahead.
Booyah. Booyah, brother. Listen, Jim,
I've been looking at a steady Eddie here, and I really like this company. It seems to have done well in 2024. The company is Dover, my man.
You bet. Dover, they report next week. Travel Trust owns it. I think it's going to be a good quarter. It's also a data play. It's a climate. It's everything. But the main thing is it's in the data center. That's why we like it. A lot of other reasons that are good, too. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, how CVS lost its way. Cramer's got the receipts. Next.
I spent a lot of time talking about different companies and how their stocks represent amazing opportunities. There's so many good ones that you need to own some individual stocks. You can't just park all your money in index funds. But maybe I don't talk enough about how hard business can be. Many of the people who run companies are amazing, but sometimes the environment is so bad it doesn't matter. Sometimes a sector itself is so awful, there's no turning it around. Often these stories are self-evident. I remember going out to see the management of Borders Books in Ann Arbor, not long after I'd written a bunch of books. This is early on, like 2006, 7. You may not even remember Borders. It decided to liquidate 13 years ago. It's one of the first megastore chains. It was a joy to shop there. But when I met with management 5 years before the liquidation, I was shocked at what I saw. It was a bunch of people sitting around a table who really liked to read, actually read. They wanted to talk about books. I had a fabulous time. I'm an avid reader myself, but I knew something they didn't. At that conversation, I knew that Borders was just dead. The idea that it was about books and not about selling books online meant that they were going to be wiped out by Amazon. Running a bookstore became a real big business once everybody started buying books online. This is about a decade after they did the exact same thing to records and record stores. I bring this up because I found myself thinking about Netflix today. There were some fascinating parts of that conference call, parts that reminded me of my visit to Borders before Amazon wiped it out. When the Netflix people speak about linear TV and its business model, they're very matter-of-fact about its limitations. When you listen to the call, though, you get the sense that the networks are all from the Borders world. They have legacy programming for their streaming services that isn't what people want. But instead of fixing it, they just double down on it. They bundle their streaming platforms together with some other legacy networks. It's funny. The networks have it in them to be like Netflix, but the Netflix execs have written them off the same way that Amazon wrote up Borders. They just didn't say it. That's why media and entertainment are bad businesses. They produce really expensive products just like they did in the 80s. Nothing seems to have changed. Cop shows, doctor shows, firefighter shows, often just in different cities. They're actually choosing to be Borders, for heaven's sake. Still time for them to pivot, but pivot they must. And I say that as a person who's actually run some successful businesses in my time. Speaking of bad business, this morning, Karen Lynch, the CEO of CVS, was replaced by David Joyner. He's an internal exec. I think that Lynch, who was on our show several times, was doing her darn best. But now that Amazon can do same-day delivery service, drugstores have become, well, Borders. We know what we want, and when we can have it delivered for so little money, thanks to Amazon Prime, we don't want to go to stores where the same items are basically under lock and key. You got to call a salesperson over. You feel terrible bothering them. CVS has tried to get away from that by diversifying into pharmacy benefit management, medical insurance, home health insurance, walk-in clinic. Yeah, you get it. That's created a sprawling company that may be too hard to run. In an era where workers are so hard to come by, think clinicians, pharmacists, nurses, it's just too expensive to put out a premium product that can produce big profits. Plus, pricing anything when it comes to health insurance requires a level of precision that's really difficult to come up with. These are all hard businesses. I want Joyner to do his bit. I want Joyner to win. But Lynch was very good. It simply feels like she could never outrun Amazon. Maybe one thing that can help, we are seeing reports this very evening that Cigna and Humana might be re-pursuing a merger. That's right, pursuing it again. Consolidation buys time. But the current FTC and Justice Department will never block that deal, and these guys supposed to know that. They must be hoping for a Trump victory or something. Now, things can change. But for change to happen, every business that's a potential Borders has to recognize their vulnerability and become something else. Otherwise, they will be disrupted into oblivion. I'm not saying that CVS can't be saved, or CBS for that matter. I am saying that it's mighty hard to invest in something that could be the next Borders. It's better to invest in the companies that are disrupting the Borders of the world, like a Netflix or an Amazon. Even if their legacy competitors didn't initially see them coming, at this point, well, they've got no excuse. I'd like to say, as always, bull market summary, I promise I'll provide just for you right here at Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.